Thank you for standing by, and welcome to the Sims Metal Management Limited 2020 half-year results conference call. All participants are in a listen-only mode. There will be a presentation followed by a question and answer session. If you wish to ask a question, you will need to press the star key followed by the number 1 on your telephone keypad. Today's presentation may contain forward-looking statements, including statements about financial conditions, results of operations, earning outlook, and prospects for Sims Limited. These forward-looking statements are subject to assumptions and uncertainties. Actual results may differ materially from those experienced or implied by these forward-looking statements. Those risk factors can also be found on the company's website, www.simsmm.com. As a reminder, Sims Limited is domiciled in Australia, and all references to currency are in Australian dollars unless otherwise noted. I would now like to hand the call over to Alistair, Group CEO and Managing Director of Sims Limited. Please go ahead.
Thank you and good morning. It's a pleasure to be here in Australia delivering the half-year results for Sims. Joining me on today's call is the Group Chief Financial Officer, Stephen Mickelson, and Bill Schmidl, the President of Global Trade. The slide presentation that we will run through has been lodged with the ASX along with the results release. As you can see on slide 3, the format for today is that I will run through a general overview of performance and the highlights for the first half fiscal 2020. I'll then hand over to Stephen, who will take us through our financial results before I discuss some of the company's strategic priorities and near-term market outlook and the challenges. Following that, there will be time for Q&A. Now turning to slide 4. The rapid collapse in ferrous scrap prices in September 2019, combined with historically low silver prices, severely compressed margins and resulted in a first half loss. This period has been challenging for all metal recycling companies globally. However, prices subsequently improved and some recovery is evident in the market. While it is disappointing to present a first half loss, I believe an attractive long-term outlook remains. We are progressing the rollout of our strategic growth plan, and I'm pleased with the progress to date, including the testing of Sims Auto Shred residue with 2 technologies. The results supported previous returns and demonstrated good environmental outcomes. Secondly, recycling with cloud volumes reached 9,000 tonnes this half and are on track to reach our FY20 target of 20,000 tonnes. Thirdly, we won an additional municipal recycling contract in Florida, and the terms of this contract mitigate commodity risk. Lastly, the new regulation in China allows the import of our high-quality non-ferrous material and validates our strategic push to increase retail non-ferrous volumes in North America and other regions. Turning to slide 5, which highlights some key figures. The challenging business conditions that confronted us in the first half are self-evident across all our metrics. Despite the loss-making position, we are paying a fully franked interim dividend of 6 cents per share, and this demonstrates our confidence in the business and its performance over the medium term. The dividend was ultimately constrained by available franking credits, and we returned a further $22 million in share buybacks. Now on to slide 6, our safety slide. Excellent safety outcomes require continued focus in identifying and managing risk. We have maintained focus and made progress on critical risk awareness and management, as well as increased safety-related communications. I'm pleased that this has flowed through to our safety measures, which has seen a reduction to 1.2 for this half year. Turning now to sustainability on slide 7. I have said many times before that the core of Sims' business model is sustainability. Our business makes a positive contribution to society by not only reducing waste that would have otherwise gone to landfill, but also lowering CO2 emissions. In 2019, we announced our purpose to create a world without waste to preserve our planet, and the growth strategy. Our sustainability strategy aligns with these, and we are now developing our long-term sustainability goals. We will host an environment, social and governance briefing on the 19th of March this year, and I look forward to further discussing sustainability with you then. Slide 8 provides the high-level consolidated financial results for first half fiscal 2020. Stephen will be covering the financials in considerable detail, but I do want to highlight that despite the setback of this first half year, I am adamant that we must return the business to achieving above a 10% return on capital. Turning now to slide 9, which provides charts on market conditions. The two charts on the left depict prices in our key commodities over the last 2 years. As you can see, ferrous reached its low point in September and is currently $50 per tonne higher despite volatility in recent weeks. There is good news in the Zorba price, as you can see from the bottom chart. We have seen a recovery in Zorba pricing since January, and so far Zorba has shown resilience following the coronavirus, holding close to $1,000 per tonne. This in part is due to China reclassifying high-grade non-ferrous metals as renewable metal rather than waste, enabling import of these materials from 1 July 2020 without quotas. This means about 90% of SIM's non-ferrous grades of scrap can be imported into China, validating our investment in quality initiatives and our strategic growth of non-ferrous retail volumes in North America. I'll hand over to Stephen now for further detail on the financial results.
Thanks, Alistair. I'm on slide 11. I appreciate that the half year is a little complicated, but the adjustments between statutory EBIT and underlying EBIT fall into three main areas. Firstly, we've written off a legacy brand that is no longer used in the US. Rather than continue to amortise it over the next 8 years, we've expensed it in its entirety. We have also written off goodwill in those European businesses that remained with us following the sale of the compliance scheme operations. Secondly, we've increased the estimate relating to an environmental liability we have in the US. I am confident that this now fully covers that commitment. And finally, we have responded to the challenging first half conditions with an extensive restructuring and cost reduction program that will achieve its full run rate of $30 million in FY21. We will get close to a 1-year payback here, and this is about setting the business up to operate and perform through all market conditions, not just a tactical response to challenging markets. Slide 12 shows for convenience the summarised EBIT and volumes by division. I won't talk any further on this slide because the subsequent slides 13 to 19 contain more detail, and I will speak to each of them separately. Before I move on though, I have one overriding comment. All metal divisions, to different degrees, were heavily impacted by the September scrap price crash. Now, North America Metals on slide 13. North America delivered a break-even result despite challenging market conditions. The metal margin declined due to intense competition for lower ferrous scrap inflow and weak silver prices. Proprietary sales volumes were down 9.6% over the prior corresponding period. However, non-ferrous volumes remained stable. It is encouraging to note that our technology investments are performing as expected and providing higher material recovery. Turning to slide 14. ANZ achieved positive EBIT margins in the first half of FY20, which was supported by internal initiatives and a swift cost reduction response. Non-ferrous volumes remained resilient. However, ferrous volumes were lower due to lower pricing, which was partially offset by continued healthy demand for ferrous scrap from Australian steel mills. Moving on to slide 15 and UK Metals. The UK experienced a particularly poor first half. Negative EBIT margins were a result of unsold inventory in the first quarter of FY20, which was then sold at a loss, combined with low ferrous and Zorba prices, leading to intense competition for reduced volumes. While this result is disappointing, we undertook a strategic restructure and lowered the operating cost base while maintaining operating capacity at our FY19 levels. This puts us in a good position for any future events. Turning to slide 16 and Sims Lifecycle Services business. Following the sale of the European Compliance Scheme operations, we are focusing the business on end-of-life cloud services. That includes reusing, redeploying, and recycling. The word lifecycle better captures everything we do in ensuring cloud infrastructure is in use for as long as possible and stays out of landfill. The strong first half result was driven by improved recycled cloud volumes, better purchasing, a higher gold price, and maximising profit opportunities prior to the sale of the European Compliance Scheme operations. Moving on to SA Recycling on slide 17. SA Recycling was broadly impacted by the same market influences as North American metals, but the fall in Zorba prices in particular materially eroded margins. As Zorba prices fell from an average of $1,000 per tonne in FY19 down to an average of $800 in the first half of FY20, SA Recycling could not lower its shredded feed price without seriously lowering intake volumes. On to slide 18. Underlying EBIT on a constant currency basis for global trading improved 17.8%. This was due to lower operating costs, partially offset by lower brokerage volumes from SA Recycling. The final segment we analyse is on slide 19, Corporate and Other. 2 points to note here. Firstly, corporate expenses on a constant currency basis increased 4.1%, largely related to advisory fees for restructuring of business systems and processes. Secondly, Sims Municipal Recycling improved $1 million due to the agreed paper price adjustment resolution with New York City, which was partially offset by higher disposal costs. I'm going to slip over slide 20 as it presents for convenience a consolidated picture of volumes contained in the previous slides, and I'll move straight to slide 21. Net cash has fallen from $350 million at 30 June 2019 to $150 million at 31 December 2019. Nearly 3/4 of this movement is related to our flagged lower operating profit, return on capital, and dividends to shareholders and capital expenditure. The remaining portion, approximately $60 million, relates to working capital. Roughly $50 million of the movement is due to seasonality in our first half cash flow, and we saw this in FY19 as well. There were some large provisions and creditors recognised at 30 June, but paid in the first half of FY20. My final slide, before I hand back to Alistair, is slide 22 on capital expenditure. We have reduced our FY20 total CapEx forecast to $180 million, down $25 million from our previous update. It excludes any bolt-on acquisitions in the metals or energy businesses. While the company has a sound cash position, we will remain disciplined in our approach and allocation of capital. I'll hand back to Alistair.
Thank you, Stephen. Turning straight to slide 24. The next couple of slides are going to look at the progress of our strategic growth plan. Firstly, our resource renewal business. This business will convert 1 million tonnes of auto shred residue into high-quality products. After detailed feasibility studies, including the testing of our own ASR, we have now selected plasma gasification technology. This technology supports previous internal rates of return and will provide us with the flexibility to choose between a number of outputs and maximize commercial outcomes across Sims' global footprint. Importantly, these plants primarily use our internal material that has no other use, and the gasification process has excellent environmental outcomes and doesn't produce CO2. Turning now to slide 25 and Sims Lifecycle Services. The remaining global e-recycling business has been renamed Sims Lifecycle Services, as this better depicts the activities it will undertake. The business has a strong base to grow from. It is an integrated service provider, a secure partner, and enables sustainability and compliance with global standards. In this first phase of growth, we are setting the foundations to scale the business in a service-orientated and cost-effective way. We've engaged with all major global cloud providers across multiple products and regions, and I'm particularly pleased that we've delivered increased recycling the cloud volumes in this half and are on track to achieve our target of 20,000 tonnes in FY20. Onto my last slide, the first half FY20 results and the outlook. Firstly, to summarise the first half, it has been a half with very challenging market conditions, and the business has responded in strategically restructuring to achieve annualised cost savings of $30 million in FY21. As I just discussed, I'm encouraged by the progress of our strategic growth plan, and I believe an attractive long-term outlook remains. The outlook for the remainder of the financial year has both risks, such as the impact of the coronavirus on ferrous and non-ferrous demand, and prices and opportunities. We still expect the second half FY20 result to be within the previously guided range of $40 to $60 million after adjusting for the sale of the European Compliance Scheme operations. Finally, before handing back to the operator for questions, I want to thank all of our employees for their dedication over the last 6 months in these challenging market conditions. Operator, back to you.
Thank you. If you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. If you wish to cancel your request, please press star 2. If you are on a speakerphone, please pick up the handset to ask your question. Your first question comes from Owen Birrell with Goldman Sachs. Please go ahead.
Hi, guys. Obviously pretty tough operating conditions at the moment. I'm just wondering if you can give us a bit of colour around what you're seeing with respect to seaborne demand in the last few months. I mean, through December, we saw pricing rise quite materially, and it's come off a little bit. But just wondering what you can give us a sense on that, and I guess associated with that, what you're seeing out of Turkey at the moment.
Thanks, Owen. From a seaborne point of view, we've seen markets go up and down in terms of the actual pricing of shipping. Obviously, there was a rise in the cost of fuel when the low sulfur fuel oil parameters came in. But in terms of the actual shipments to Turkey, and in terms of the numbers of cargoes we've seen heading across to Turkey, I think they're still quite good, still sitting around the 30 to 35 ships per month. Bill, I don't know if you've got any comments on that?
Yeah, I would just add that the Turkish activity has been fairly consistent. We did see a decrease in prices about 3 to 4 weeks ago of approximately 10%, 10 to 12%, but as of today, we've gotten about half of that back. In essence, the market went from 300 to 260. Now it's back up around 280 and probably a little bit higher than that. If there's a weakness, the weakness is closer into China, into Southeast Asia, which has been, rather quiet. There's been some activity in the subcontinent, but other than that, it's been a quiet market. That's about it.
Okay. And just, I guess, looking on that Asian markets, obviously it's probably pretty too early to tell on the impact of coronaviruses, but just wondering if there's any update on the non-ferrous regulatory environment out of China. I mean, it's something sort of was supposed to come through mid last year, but we really haven't heard much in terms of how that market dynamic is evolving.
Okay. Well, I think that what was previously waste is now being classified as a renewable metal, which is obviously good for us. That's a commodity. And when you look at our non-ferrous products, 90% of all our products meet that standard straight away. Given that we send probably 30 to 40% of non-ferrous exports to China, the investments that we've made, obviously, I'm very pleased that we can deliver that quality and that diversified portfolio across. So from a quota system, we see that falling away by the end of this year, and that our products, the standard is you've got to basically be 99.3% metallic content, and we meet that standard. And obviously from an aluminium point of view, when you're looking at Twitch and the Zorbas alike, they've got to be at a 93% aluminium content. So that and the expansion of our non-ferrous strategy, they're all aligned. So I think it's probably a good outcome for us in terms of that reclassification. Called it renewable metals.
Okay. And just one final question for me on the capex. The reduction in the capex by 25 mil. Just wondering if you can give us a sense on, I guess, where is the 180 mil going towards? Like what are the projects that's underpinning that 180 mil, and what was the project or projects that were deferred in that 25 mil?
Yeah, Owen, Stephen here. So I guess what we're really going to focus on in this for the full year is maintenance, sustaining capex, and safety capex. So they are going to be the number one priority, and they're probably around 130, 140 million of it will be those areas. So definitely keeping the business running and no compromise whatsoever on safety capex. The bulk of the rest of it, we've got the Avonmouth upgrade that finishes late January. It finished late January, maybe by the end of February. I think it's all up and running. So that will be there. The rest of it is just sort of minor growth capex projects that we'd already commenced, and they will continue through the end of the year. What have we stopped doing? What have we deferred? It's what we considered non-essential capex or capex that was oriented towards some growth projects that were there, but whether or not we take those growth projects this year, next year, or the year after will be determined by how comfortable we are in the business and where that's heading. So I think it's just been sensible capital rationing.
Okay. And just in terms of the potential for bolt-on acquisitions, I was going to say this market environment, the market probably not going to want to see you spending on any bolt-ons, but ironically, it's probably the environment that is going to provide you with the greatest opportunities. I'm just wondering, is there any of your targets that you previously had on your radar, becoming more attractive around these levels?
Yeah, look, it's a good point you make. We've stated we'll be disciplined, and we will absolutely be disciplined. So they have to meet our hurdles, and probably that's why you've seen us been reasonably quiet over the last few months, because things have been put up, but they haven't met our hurdles. I do agree that it's often times like this which it is the best opportunity, because you're getting things at the bottom of the cycle. We do have some things in the pipeline. We are working through the numbers. Not there yet. We will be disciplined. I guess that's probably all I can say.
That's all from me. Thanks, guys.
Thank you. Your next question comes from Jack Gabb with Merrill Lynch. Please go ahead.
Thank you, and good morning. Just two quick questions from me. Firstly, just in terms of going back to the European compliance operations sale, can you give us an update on the timing for when you expect to receive the proceeds from that? And linked to that, in terms of the restructuring charges or provisions that you've made, is the majority of that linked to the European compliance operations, or is it a broader sort of cost-cutting program that you're making? And then secondly, just on volumes, obviously you pre the collapse in the ferrous price back in September and early October, I guess we had longer-term targets for North America. Just kind of wondering how you're thinking about that sort of 2025 target for both the ferrous and non-ferrous side now. Thank you.
Okay. I'll take the European sale is obviously going to the European Commission, and we're following that process. And the estimate on that could be March, April, and as soon as that is concluded, then I would see the proceeds come in after that. So it's really up to that Euro Commission process at this stage. In terms of, let Stephen answer the provision one, but I'll just talk about the volumes in North America. The long-term targets are still our target in terms of being able to deliver that. We still believe both the ferrous and non-ferrous targets are still realistic, and certainly what we're shooting for in the long term. So whilst we see a slight decline in terms of the ferrous volumes this year, and then the target of 5 million that we set, I'm comfortable that the targets are correct, and obviously when market conditions are a little bit more stable, I would expect us to be able to achieve that. The non-ferrous market for us, as you can see, even during this last 6 months tough period, the non-ferrous volumes are pretty much flat, which is also a good indication that we're heading in the right direction. So very comfortable with those targets. Stephen, maybe you can talk about provisions.
Yeah, sure. Looking at the restructuring and redundancy provisions, by far the bulk of those are in the UK and NAM. From a materiality point of view, none sit in Europe. The main implication of in terms of significant items of the sale of Europe, the compliance scheme operations, is the businesses that were left that the businesses we still own that are left back in Europe. They had intangibles which we've impaired to the tune of $13 million. Now, they used to be part of the wider Europe CGU, the cash generating unit, but since we've sold the European operations, I'll be frank, they didn't stand on their own in terms of the valuation of those intangibles and goodwill, so we wrote off around about $13 million. But just reiterating my first point, the restructuring and redundancy provisions around us, I think taking very sensible restructuring in both the UK and NAM.
Thanks. And has some of that restructuring been yard closures in the UK? I think you were looking to focus on some of the bigger yards, not necessarily reducing the potential volumes longer term, but just more of a cost move. Is that right?
Exactly right. Exactly right. So we've sort of closed or shuttered 11 yards, and we've taken the volumes that they were producing down into 4 of our existing yards. So we've beefed up those 4 yards a bit to handle the volume. So we fully expect to be able to handle the same volumes we handled in FY19. We have that no capacity has been removed. We're just saving the costs on these 11 sites, which I think again was a solid and logical rationalisation.
Great, thank you. I'll pass it on.
Thank you. Your next question comes from Lee Power with CLSA. Please go ahead.
Morning all. So just continuing on from Owen's question, do you factor in any further recovery in Turkish prices in your guidance for the full year?
At this stage, we're still looking around the 280 or 250 to $280 mark. That's where we're sitting today. I think it's a little bit early. I'm obviously working with the team and just watching very carefully the global sort of growth, and that's all related to the virus in China and whether that's actually going to be contained and we can see a more stable environment. I think at this stage, that's the guideline we sort of are looking at around the 280 mark. Hopefully, the virus can be contained and we can see more stability, and hopefully that price move up. But at this stage, we've been cautious in operating between 250 to $280 per ton in terms of ferrous. In terms of Zorba pricing around the $1,000 mark, maybe slightly over that. But again, both of them are watching the Chinese outcome of the virus.
I might just add on one more thing there, because I think the implication, or what I infer from your question is, higher prices would automatically lead to to a higher outlook, and maybe that is the case, but it's very important that there's lots of factors. So the buy price is important. So, I'll give you 4 examples. If we headed to higher prices, but there was, a very aggressive competition came into the market, and that margin was eaten away, the higher price in and of itself might not lead to a higher outcome. Having said all that, clearly we'd be pleased with higher prices.
Okay. And then just on the UK restructuring, can you give us an idea of how much lower the break-even point is, or maybe like break-even tons or some sort of metric we can look at?
Look, I can't, off the top of my head, I can't know. Let me think about that question a bit more, because it is quite a complicated question around, particularly around these levels where break-even is volumes versus margin, because margin is going to be probably, I'll be frank, just as important as volumes in the UK for us break-even. So as much as I'd love to give you a rule of thumb, I think it is a complicated combination of those two.
Okay. That was kind of going to lead into my next question, which is hitting the full year guidance. Is it more a question of volumes coming back, or is it a cost out story?
So I think it's three, because I'll add in margins as well. So the cost outs have happened. We're just about through them. So we'll hit the full run rate certainly by the time we get to the end of the year. So I absolutely expect the cost reductions to be contributing to our guidance. we would need to see volume. Both it'd be good to see the volumes solidify, around these types of levels and see some margin come back into the business. So we haven't got overly optimistic assumptions, as you would naturally assume, in that confirmation of our guidance. And I think we've probably summed up the risk factors pretty well. So it's all three, but there's no particularly heroic assumptions on any of those three that we have.
Okay, thank you. I'll leave it there.
Thank you. Your next question comes from Peter Steyn with Macquarie. Please go ahead.
Morning, gents. Just probably carrying on that tangent, the 30 million cost out that you're targeting, could you give us a better sense of that geographically, Stephen? Is it, I presume the UK is making an outsized contribution given what you've done from a site perspective, but could you give us a better sense of that?
Yeah, I can. Look, you're right. The UK is making a larger contribution because that's clearly, we've closed the sites. We haven't closed sites in NAM, so it's split. It is split between UK and NAM. It gets a little bit complicated, but I would say you're probably looking at 3/4 of it at least is coming from the UK in terms of contribution from that restructuring redundancy provision. The balance from NAM and a small amount from Australia.
Perfect. Then was curious just to get a little bit more detailed perspective from Bill around Turkey and how you guys are thinking about the progression of that market, both domestically and from an export perspective. Obviously, there's been a lot of moving parts. If you could give us a bit of clarity on that, that'd be great.
Yeah, Peter, it's the Turkish market domestically appears to be slightly better than it was this time last year. The winter is always a difficult time there. Construction, regardless of the veracity of it, will slow down. But the signs for spring and some incentives that the government has put in with lowering interest rates, etc., give a better outlook. I wouldn't call it a bright outlook, but a better outlook. As far as their export market goes, over the next few weeks we should see what the European quota will be for Turkey, which will give them another outlet. Their biggest, as you probably know, Peter, export destination is North Africa and the GCC to some extent. Asia is an important, add-on, but not totally critical. North Africa seems to be in okay shape. Demand seems to be consistent. Pricing is difficult for the Turks today. Rebar pricing was in the $430 range about a month ago, and is down into the $415 to $420, and billets have gone below 400 to around 390, but that seems to have solidified the market there, and prices have slowly started to increase. As far as scrap prices go, going into January, I was relatively optimistic about not just Turkish demand and steel in general, but worldwide demand. It looked like we were finally going to come out of the worldwide manufacturing recession that we've been in for over 18 months, and there were a lot of macro pieces that made things look better. And the first thing, of course, was the U.S. and Iranian issue, which essentially stopped the market for the first couple of weeks in January. And then more and more news came out about the coronavirus, which, certainly made people sit and wait. But regardless of that, after that 2 or so week period, the Turks did come back to buy, and as Alistair pointed out earlier, the number of cargoes they're buying is about on average. So they continue to operate. They continue to fight. Work on probably lower margins than they would like to. But they are continuing to melt. The operating rate hasn't decreased from where it was in the last quarter of 19. And the surrounding areas have been fairly active as well, whether that be Egypt or Greece or, the GCC has been fairly active as well. So, as the market got down under 300, it brought a lot of people back into the market, which solidified it and why it bounced back up into the 280s. I'm not sure if that answers your question, but
thanks, Bill. Yes, that was a broad around the grounds. Thanks. Just one last quick one on China in particular. Alistair, 10% of your sales last year. You now have a little bit more of an incentive to focus on that market given your competitive position. How do you think about that strategically from a pivot point of view?
In terms of our non-ferrous to China, Peter?
Non-ferrous, yeah.
I think, the overall strategy is that we wanted to be able to have our non-ferrous products being able to be sold around the world, and China obviously is a large part of that, or 30 to 40%. The Southeast Asian region, when you look at China, India, Malaysia, that entire region is obviously the focus for a lot of our non-ferrous sales. And I think technically we've done what we needed to do, which has given us the capability of varying qualities. And if there's a premium in a quality product, then we can go after that. And so I think we've diversified a customer base, but also given ourselves the technology to be able to sell and hopefully extract premium in the coming years.
Perfect. Thanks for that, Alistair. I'll leave it there.
Thanks, Peter.
Thank you. Your next question comes from Simon Thackeray with Jefferies. Please go ahead.
Thanks. Good morning, gents. I'm probably a bit slower than the rest, so I just really want to try and step this through. You've got a targeted exit run rate on cost savings of $30 million this year, 3/4 plus coming out of the UK on consolidation. You've got an assumption of ferrous prices of $250 to $280, Zorba at $1,000. All things being equal, prices weren't anywhere near that in October when you gave your last update, and yet the guidance is unchanged. So, you can call it conservative, I presume, but does the math actually make sense? I just need you to maybe waterfall for this or step me through, because things have improved, and the way you always explain things, Bill, was that 6 weeks to build a cargo, forward sold. Those prices were improving dramatically through November and December in terms of ferrous scrap. That should be a good quarter, Q3 for the business, all things being equal. And the one thing that seems to be missing from the pack, this result, is that wonderful quarter by quarter sort of EBIT performance that seems to have disappeared. So it's leaving me, certainly, I'm not going to say us, leaving me a little bit more confused about how you get to this guidance, given the conditions improved in the final quarter, the final parts of 2019. They should be benefiting you in the third quarter. So are you assuming a much weaker fourth quarter, or how does this work? How does the math work?
So Simon, it's Stephen here. Let me try and pick that apart a bit, and I'm sure that Alistair and Bill will chime in as well. So there's a few things in there, so let me go through some of them. Firstly, we had absolutely initiated our cost out, or begun to understand what our cost out program was when we came out. So we reacted to that very, very swiftly, and while we're implementing it now, that was built into our full year guidance. So we knew that we were going to what we were going to do. It's going to take us a while to implement it, but that was certainly built in there. So I wouldn't view that as additional. Secondly, and I think it somewhat relates to the points I talked about before. Price is absolutely one of the components. But the other component you have to look at, and one which is just as difficult for us to forecast as it is for the market to forecast, is what is the level of competition going to be? What is the buy price going to be at particular levels? And we have seen, particularly particularly in this first half. We have seen some fairly aggressive buy price activity. I mean, some of it doesn't completely make sense to us because we can't see how you're making margins at those. But I guess in a market that has been as volatile as it has been, and some of the volatility has been extraordinary. We were just sitting back and having a look at it the other day. We've had 10 and 20% swings month on month, both up and down in pricing, and that makes understanding where your buy price needs to be from a competitive point of view very, very difficult. So that's that. The third comment I'll make, and before Bill and Alice want to chime in, we actually got very strong feedback from our shareholders that they didn't like the quarterly slide, that they thought it added volatility to our business and made it much more short-term focused than it should be. So I guess we've listened to those shareholders. I acknowledge as an analyst you might not be overly happy with that, but we've listened to that feedback and not included that slide.
That's very helpful, I have to say. The only concern that I have is that it's price, commodities, price, volume, they all go together. To have that kind of underlying volatility in buy prices, and there was some explanation for it in North America in terms of seasonality as well. But if we're saying it's a highly volatile environment, I accept it's harder to give guidance. So it's very difficult for me to understand with any kind of clarity what 3Q or 4Q could look like. It feels like a bit of a dartboard from the way you're describing how volatile the environment is. So I mean,
I wouldn't describe it as a dartboard, and I guess what we're saying is,
well, you just described the buy price as being highly volatile, moving 10 to 20, 20%.
Yeah. So what I described
that's pretty volatile.
Yes, it is, and I've described it as what we've just been through. But bear in mind that was driven by a scrap price crash in September that was around 3 standard deviations from the norm. So we're talking a very significant event, and as it recovered in a very volatile fashion, and that caused volatility in the buy price. We have seen some stability return. We've absolutely seen some stability return, and that is one of our assumptions. I will make that very clear. One of our assumptions when we're looking at where we think we're going to come in at the year end is that somewhat level of stability that returns remains. If it went to another highly volatile market, I don't know, the coronavirus, who knows what could cause that level of high volatility, then that would clearly be a major change to our assumptions.
Okay, well that's helpful. Can I just swap across to something that I also don't understand, but looks pretty interesting, is this cloud recycling. You made a reference to the link to the gold price. I probably didn't understand. I don't understand what the drivers of that business are. So I just wanted to understand a little bit more about that reference to the gold price. And also, it sounds like a pretty attractive large market, growth market. Just what the current competitive environment is in the recycling of the cloud and what you expect it to be over the next sort of couple of years?
Yeah, sure, Simon. So the reference to the gold price actually references more our business that we sold on 30 September. So what we're saying is that traditional scheme operations did quite well in the first quarter, partly because of the gold price. The gold price doesn't have a big influence on recycling of the cloud. We do view it as a potentially very good opportunity. I guess what what we've been consistently saying over the last year, what we find attractive about it is it's low on capital, so it's a no regret strategy for us. We can cycle the costs up and down very quickly as the market volumes rise, or if they don't rise, we can pull it back pretty quickly. So we review it as a no regret strategy because it doesn't involve capital. I guess we view it as an attractive market for us for a number of reasons. One is it's global, and Sims is very much a global player. The type of companies we deal with are the names as you expect are the large global providers of cloud services, infrastructure as a service as they now call it, to large players. So they are interested in dealing with a large reputable industry player, which we are. And I guess thirdly, over the last 5 to 10 years in our ITAD business, which is our IT asset disposal business, we have actually built up a lot of expertise in this area. So we think it all comes together. I will admit it's a blue sky opportunity, but we view it as a low risk blue sky.
Sure. And I might just add one other comment there is that in terms of competition, there are other competitors in this in the USA, but from what we can see at this stage, they are not global competitors. And obviously one of the key focuses for any one of our large customers goes around the security of managing their product. So we do have an advantage in that sense as well.
No, that's helpful, Alistair. And then one real quick one to wrap up. Just ANZ, another good performance from that division. You cite sort of good, strong domestic demand for scrap, and Bill's point about Asia being quieter from the sort of global trading perspective is obviously pretty well known. Just in terms of if you can, just in terms of the split between sort of the export tons and the domestic tons, and that relative resilience of ANZ, and I'm probably a little surprised. I thought that maybe it'd feel that Asian pressure a little more in this half. What are you expecting for the second half then, as well for ANZ?
The split would remain pretty much the same as it is and has been for a while. So it's just a 50-50, pretty much domestic versus export. So there's a solid demand for both. Naturally, we watch the pricing, but I think the export volumes should be the same as what we saw in the first half.
Great. Thanks, guys. Appreciate your time. Thank you.
Thank you.
Thank you. Your next question comes from Daniel Kang with Citigroup. Please go ahead.
Good morning, everyone. Just maybe a question for Bill or maybe Alistair. In terms of Zorba pricing and US domestic scrap pricing, they've rallied and they've actually sustained their strength. Just be good to hear your thoughts on the drivers here and whether you expect this strength to maintain.
I'll take the Zorba pricing issue first, and obviously, we're just over 1,000, close to $1,100 per ton at this moment, and from a stable market environment point, it's good that we've seen that rise in Zorba pricing from the lows of 800s early in last year. Part of that is obviously got to do with China in terms of that economy and whether that upswing is going to come to see if any of those Zorba prices rise. But we're suggesting that it's going to stick around the levels that you're seeing today, and the drivers really is the motor car industry. So that is something we've got to watch very carefully across the globe. In terms of the USA domestic scrap pricing market, I'll hand over to Bull over there, but I think the one thing I would comment on is the volatility we saw in domestic scrap pricing for ferrous last year.
Daniel, were you mostly interested in non-ferrous or ferrous in the U.S.?
Ferrous, Bill.
Ferrous, okay. Yeah, no, I think the outlook is pretty good for ferrous in the U.S. for the whole year. There are finally some infrastructure projects that are being funded. The outlook, I think, the order books that I speak to about with Nucors and others are fairly solid. Plate may be a little bit weaker than they would like, but flat products seem to be, going pretty well. That doesn't mean that the market hasn't been volatile. It's been extremely volatile, probably more volatile than the export market over the last, say, 8 months from July to February. And I think the next couple of months, that volatility will abate a bit. I think we'll get off the 10% changes every month to something more reasonable. At least that's the way it appears to me now. But of course, that is affected by the international market. So it's really difficult to make an accurate judgment. But I'd say it'll be less volatile in the next few months than it has been.
Thank you, Bill. Just another question in terms of the buy price. I think in your guidance you mentioned that you've noted some softening in terms of the aggressive competitor behavior on the buy price. Typically, do we tend to see competition reduce as prices rebound?
I think when you see pricing increase, and I'll take you back maybe 18 months, 2 years ago, when you see prices up in the 300, 350 range, there's obviously a lot of scrap that flows in that sort of price levels. And whilst there's competition, there doesn't seem to be that much of a bar price fight. It's more relaxed, and given the volumes are flowing and people can actually extract their margins. What we've seen is when pricing becomes difficult is when we see the prices down in the 250 mark and volumes are starting to slow down, and individuals have committed to a sale, then you see a lot of competitiveness, and that could be literally within 5 miles of an operation, and that's where I think a little bit of the competition that we talk about in the bar price does affect the competition in a particular region. And we've seen in the UK and in the US, in certain parts of those countries where we have a higher level of competition, on one coast versus another, or a domestic versus an export competition in the UK. So I think pricing and that competitive environment is quite specific to regions.
Okay, thanks, Alistair. I'll leave it there. Thank you.
Thank you. Once again, if you wish to ask a question, please press *1 on your telephone and wait for your name to be announced. Your next question comes from Brennan Chong with UBS. Please go ahead.
Hi guys, James Brennan Chong here. Just a couple of clarifications on what you think the reclassification of China's non-ferrous material will mean. Positive to see that 90% of your products will be making that threshold. So 3 quick questions on that. 1, what do you expect will happen to the remaining 10%? 2, do you expect any costs of compliance to ensure that your 90% of those non-ferrous volumes will get in? And thirdly, at a macro level or an industry-wide level, do you think that you are standing out, being able to put in 90% of your volumes into the Chinese market once this reclassification is done, or do you think that the broader market will also be able to get 90% of its volumes into China as well? Thank you.
Good questions. The 10% of our products you talk about, as I said, we send 30 to 40% of our product actually goes to China. So we are quite comfortable that we are capable of delivering that 90% to China. The remaining 10%, there's markets, and if we don't have to have higher operating costs for those 10%, then there's markets for that. So quite happy with that 10% and where that goes to. In terms of your second part of your question, there are very small packaging costs that we've noted that China regulations have asked for packaging to be quite specific, sort of 1-ton bags. So there's a little bit of a cost around that we would need to do, but nothing major. Then the third part of your question, in terms of the macro and does SIM stand out, I would say we're probably leading across our group in terms of the technology we've already installed. I know some of our competitors are still going through that process. So in typical engineering fashion, you probably get a year ahead of anybody else, and then they catch up. So for us, it's really about managing our costs in producing those products, keep them as low as possible, and make sure we're diversified and have a home for all of our markets. And we are aggressively wanting to grow that business, the non-ferrous, as per our strategy.
Right. Okay, great. Good colour. And then just finally, slide 24, just on the strategic growth, converting ASR into gasification process. I may have missed it. Can you just remind me, have you chosen a location for this site? And given that you've started to engage the government, do you have any initial CapEx numbers, please?
No, at this stage we haven't opened up the locations. We're obviously reviewing that. So we haven't negotiated, but the first one we are planning on building will be in Australia. And as in any good project management process for us, the location is going to be part of the discussion with EPAs and the local governments. It's more than just one project. It's also about relationships going forward. So at this stage, whilst we've chosen the technology, we need to go through the next feasibility phase, and that will give us a level of comfort around costing. So that'll only come out after the next phase.
Right. And do you have any budgets on how much you're going to spend on studies and all of that over the next 12 to 18 months?
The board needs to obviously approve. We finished the pre-feasibility study, which is rather small in terms of capital. It's not significant at all. But the next phase in the feasibility study is probably $3-4 million at this stage, and that's fairly small.
Got it. Thank you, James.
Thank you. Your next question is a follow-up question from Lee Power with CLSA. Please go ahead.
Hi, just a quick follow-up on the cloud recycling. Can you just remind me what the split in terms of tons in that business is between recycling like obsolete equipment into its base materials versus reselling components?
Going forward, because the historic one will be completely dominated by the non-cloud stuff, because that's what we were doing. Look, going forward, let me get back to you through Angela, because off the top of my head, I don't know what the split is strategically. I mean, what I would say is strategically, our big focus will be on the cloud, but we do have a baseline of ITAD business that we still continue. But from your perspective, you should assume that most of what we want to do will be cloud going forward, and it will start to dominate. But let me get back to Angela if I can.
Okay. Thank you.
Thank you. There are no further questions, and that does conclude our conference for today. Thank you for participating. You may now disconnect.